Lesson 1. For a long time, I really thought I had figured out how to pick individual stocks. I was doing everything by the book. First, I would screen for companies with a strong economic moat, a strong brand, network effects, or high switching costs. Then, I would dig into the financials, making sure that everything was trending in the right direction. Then, I would look at the management team, returns on equities, and debt level. Only after, I will calculate its fair value, and only buy when the stock price falls below that number. I had the whole system in place. I thought that as long as I stick to the strategy, I will beat the market over the long term. I felt like a surgeon, precise, methodical, completely in control. But it is not so easy. I discovered just how mentally exhausting investing in individual stock really is. Because when a stock drops, you face the same question every single day. Is this temporary or is the company finished? Sure, you can run the analysis again. The mood still looks strong, you tell yourself it will rebound as long as it is a great company. But here's what I wish someone would have told me. The stock price has already factored in everything. Every number in the financial statement, every good and bad news, the quality of the management team, every possibilities of its business to turn around or continue to decline. All of it priced in right now by millions of investors who are also doing their homework. A great company doesn't mean it will turn around. A great company can turn into a poor company. There's a saying, you don't lose until you sell. I used to believe that, but think about what it really feels like in practice. If the stock is down 50% for 8 years, that's 2,900 days of waking up and questioning this. Do I hold or do I sell? You would think, wait, I have already held this for 8 years. If I sell now, those 8 years of waiting would go into waste. Since I have waited for so long, I must reap the rewards. So you keep holding for another 8 years while you see a boring index fund keeps going up. You are still stuck. So you beg someone to make a video analysis on this stock every week. Some video says it is a deal of a lifetime, but others says the problem this company is facing is structural, so it may never come back. You still don't know to hold or sell. This is just one individual stock. What if you have 30 stocks in your portfolio? Honestly, at this point, a therapist might be a better investment. The lesson, picking individual stocks isn't just about being smart enough. It is about whether you can handle the psychological stress of holding through years of unknown. Most people can't, and that is not a failure. That's just being human. So I have finally given up on stock picking and moved to index funds. I thought that I have become wiser, like I have finally figured it out, but I was wrong. I was still carrying a sizable risk that I don't even know existed. And the irony is, it is one of the simplest risks to manage. Lesson 2. When I first started investing in the S&P 500, I thought the strategy was simple. Just dollar cost average, ignore the noise, and I will be rewarded with a sweet historical average return of 10% a year. What I completely missed was a risk unique to Singaporeans. When you invest in a foreign market, your returns aren't just tied to the companies in the market. They are also tied to the currency. Let's say the US market goes up 500%, but during the same period, the US dollar drops 30%. The moment you convert back to Singapore dollars, your actual return is only 350%. Still a great return, but if you had planned to retire with 500k, you will fall short of 150k. And this isn't something you can just wait out. The money is for your non-negotiable goals, like your retirement, your medical costs, and your living expenses. Now you're thinking, the S&P 500 has delivered 500% return over 20 years. They will outpace any currency weakness. Well, you're right, if only it can continue to do that. The US has had a mega run in the last 20 years, but it hasn't always been the top performer. There were decades where international stocks outperformed the US by a wide margin. Nobody knows if the S&P 500 can deliver strong returns over the next 20 years. Maybe you are thinking currency fluctuations even out over the long term. This is true, but long term can be longer than you can wait. The Japanese yen fell 50% over 14 years. The Australian dollar fell 35% over 15 years. The Malaysian ringgit fell 24% over 13 years. Nobody can predict where the US dollar is heading for the next 20 years. What if your retirement comes before it recovers? The lesson, I added Singapore stocks to my portfolio as a safety net. Because if the US dollar doesn't work in my favor when I retire, I still have something to fall back on. For Singapore stocks, I personally use Moomoo instead of intermediary brokers. First, I'm not overpaying in fees. Intermediary brokers charge 0.08% with a minimum $2.50. If you use Moomoo, your commission is free in the first year. You pay a small platform fee of 0.03% with a minimum 99 cents per trade. Free commission matters a lot because your early trades are often large account transfer. After the first year, the commission becomes 0.03% with a minimum 99 cents. So if you add the commission and the platform fees together, you are only paying 0.06% with a minimum $1.98. Moomoo is cheaper than internet brokers. At Moomoo, you get visualized ETF analysis tool and free Morningstar research to support better investment decisions. Moomoo has CDP linkage, meaning your shares are registered directly under your name. Their commission is only $4.99 minimum. Compare that to traditional banks at $25. If you sign up by scanning this QR code or use the link in the description, you could get up to $1,200 in rewards, which includes $100 of Nvidia shares you won't get anywhere else. Just follow the steps on the screen and enter my special code to get yours. Thank you so much for helping my channel. So I have reduced my currency risk and chosen the right broker. But as a so-called long-term passive investor, I still had one embarrassing habit that I have never told anyone. Lesson 3. Every month when my salary comes, I was supposed to do the right thing, invest it into the market. But instead, I will watch videos showing technical analysis on charts about where the market was heading because I wanted to wait for a nice dip. For beginners, technical analysis is looking at stock chart to make educated guess where it is heading next. And you know what happened most of the time? The market just kept going up without me. And eventually, I will invest at a higher price than if I had just put it in on day one. Chart shows pattern based on how humans behave. For example, a support line is simply a price level where the stock keeps bouncing off every time it falls to that point. So you could wait for the stock price to fall back onto the line and get your money in. But here is the problem. Those patterns eventually breaks. All it takes is one news headline and the trend you have been watching for weeks is gone. Here is how I think about technical analysis now. You are staring at price patterns from the past, trying to predict what millions of unpredictable humans will do next. If you stare at a chart long enough, you can see different species of dinosaurs. And just like dinosaurs, your predictions are extinct before they even happen. Even if some TA strategy did work, the moment they became popular, they stopped working. Because hedge funds with room full of people smarter than both of us, running algorithm faster than we can blink, will exploit those signals until there's nothing left for an average investor. The lesson, the best time to invest is when the money arrives, not when the chart looks right. Waiting for the perfect entry is just procrastination with a convincing story. So I stopped waiting for the perfect dip. I started investing regularly. I felt disciplined, consistent, in control, and then YouTube completely destroyed all of that. Lesson 4. Every time I opened the YouTube app, I got hit with thumbnails screaming at me. Buy this ETF for explosive growth. This ETF is the next mega trend. AI is the next revolution. China is so beaten down that it's basically on sale. Healthcare is a must because people always get sick. Consumer staples and utilities will protect you from market crashes. And I clicked on every single one of them. Each video made a convincing case. Every sector had a solid reason to exist, and I wanted all of them. I was like someone at a buffet restaurant who puts everything on their plate because everything looks good, but I cannot finish any of it. So I sat down to build my perfect portfolio. 40% technology, 20% to China, 15% healthcare, 15% consumer staples, and so on. I think I have made more than 100 adjustments, but those numbers were completely made up. I had no real basis for any of them, and I could never stick to them. Every new video about something new made me adjust the ratio all over again. Then I stepped back and reflected what I had actually built. These sectors just take turns to outperform each other. Some sector trends take a year to play out, others takes a decade. There's no way to predict sector trends. Over the long run, my total return was probably going to be the same as just holding one broad index fund, except mine was more expensive, more complicated, and more stressful. Is a complicated portfolio actually better, or does it just feel better? The lesson, a complicated portfolio doesn't mean a better one. It usually just means more decisions, more fees, and more chances to second guess yourself. So I ditched the sector ETFs and went back to the basic. Just two simple funds. Finally, right? Except I spent years arguing with myself again. Lesson 5. For a long time, I held both an S&P 500 ETF and a global ETF, and I became obsessed with finding the perfect ratio between them. I read research papers, I compare US versus international stocks, developed market versus emerging markets, their historical returns across decades. I wanted to find the perfect split with the highest risk-adjusted returns. For beginners, risk-adjusted return simply means getting the most return for the least amount of risk. So I will start with 70% US and 30% international. Hold it for a while, and then new data will come out and I started tweaking. S&P 500 outperformed international stocks, I go heavier on US. US is getting expensive, I pull back a little. International stocks beats the US in some decades, I add a little bit more. Emerging market crushed the US in the 2000s, I throw in some emerging markets. I was basically rearranging the chairs around my house and calling it a strategy. It took me a long time to accept that there is no perfect allocation. The shift came when I realized a global ETF already decides the allocation for me. The lesson, the best allocation is to let market capitalization do the work. Every country inside the world index is working as hard as possible to climb higher and attract more investors' money. So I have stopped investing in the S&P 500 and just focus on Singapore ETF and global ETF, which include US already. 8 years, 5 mistakes. And honestly, I don't regret any of them because now I know exactly what I'm doing and why. But here's what's funny. Even after all this, I still run into people saying index funds are for people who don't know what they are doing. So in my next video, I'm going to challenge the most controversial investing myth Singaporeans still believe and debunk every single one. Subscribe now because you really are going to have fun watching this one. I will see you in the next one.